Hello everyone, welcome to Google Academy. In today's video, we will discuss IAS 1, which deals with the presentation of financial statements. Guys, what happened in the year 1997, long back, 1997, the International Accounting Standard Committee, I'm talking about International Accounting Standard Committee, which we call IASC. It merged and updated three basic accounting standards. What it did? It merged and amended three accounting standards. We already had three accounting standards to combine them. Namely, the first one was that times IAS 1, which was telling about disclosure of accounting policy. Disclosure of accounting policies. It was formulated in the year 1975. Number two was that times IAS 5, which was dealing with information to be disclosed in financial statements. Right, guys? 1977. And the third one was that times IAS 13. It was dealing with presentation of current assets and current liabilities. Right, guys? So these three standards were mixed up, were combined together, and we got today's IAS, right? These standards were merged and amended, and and we got today's IAS 1, right, guys, which deals with presentation of financial statements. When it was issued on September 1997 and enforced on 1 July 1998. When we are studying any IAS, first of all, we should know its objective, its scope. Scope we already know now, that it presents the statement of financial positions, or we can say financial statements, right? Now, what are the objectives? The objectives of IAS 1 are to prescribe the guidelines to prepare the financial statements so that they are comparable, right? We have to prepare the statements in a way it can be compared from any part of the world. We are making accounts, we can compare, right, guys? Now, what IAS instructs? This IAS 1 instructs that a company must prepare the following financial statements. What are these? Number one, we have to prepare the statement of profit or loss, right? Number two, we have to prepare the statement of financial position. Number three, statement showing changes in equity. Number four, statement of cash flow. And last but not the least, notes to accounts. Any transactions which cannot be entered in the statements shown above are shown as notes to accounts after the statements are prepared. So collectively these five components make up the financial statements, guys. Right. Now each component should be clearly identified. Right. Each component on each of the statement should be clearly identified. What are these components which are to be identified on these statements? These are number one, name of the reporting company or entity. Name of the reporting entity means suppose I am making accounts for ABC Limited, right? Every statement, whether P&L, financial, equity, cash flow, it should have the name on the top of the company for which we are making the account, and then title. Which of the four statements I am making? Title will make it like statement of P&L or statement of financial position. Any statement I am making, I have to write the name of that statement as a title, right? Then I have to mention the ending date of reporting period or period covered by the financial statement. Time period I put, suppose I'm making for the year 2025. So Jan 1 25 to December 31 25, or my financial year starts on 1st April 25. So 1st April 25 to 31st March 26, like this, right? Then the currency in which I will represent my numbers. The presentation currency. I have to mention the currency, dollar, IDR, INR, whatever. Then the level of rounding up. Suppose I'm rounding up my numbers. To what level I've rounded up my numbers, right? Up in presenting the numbers, right, guys? So this is all we have covered in IAS 1, which says that we have to prepare these statements with note to accounts, and these are the components which each and every statement should represent. And so, guys, I hope you have understood everything. So wait for my next video in which I will come with IAS 7. So guys, stay tuned. Bye bye. Take care. Have a nice time.